Disclaimer: something unusual is happening. Not loudly, not with headlines, not with emergency press conferences, but quietly, mechanically, and with precision. Tonight, when Asian markets open, the silver market will be forced to make a decision it has been delaying for years, and whatever choice it makes will ripple far beyond silver itself. Right now, as we speak, the cost of holding a single silver contract has exploded, jumping from around $25,000 to nearly $66,000 in just 72 hours. Just days ago, a trader could comfortably maintain a position with roughly $25,000. Today, that same position demands more than double the capital, and the pressure is still building. This did not happen gradually. It did not happen naturally. It happened deliberately. At the same time, something even more troubling is unfolding far away from trading screens, where prices are not theoretical, contracts are not synthetic, and numbers cannot be adjusted with keystrokes. Physical silver is vanishing, not becoming scarce, not becoming tight. Vanishing. Dealers are shutting their doors, mints are halting sales, refiners are quietly stepping back, not because demand has weakened, but because supply has simply stopped arriving. And between these two worlds, the paper market and the physical market, a gap has opened so wide that it can no longer be explained away. That gap is now stretched beyond 90%. This is not volatility. This is fracture. Tonight, Asia opens, and when it does, one side of this market will be forced to blink. Welcome to Economic Records, the channel that doesn't shout, doesn't chase noise, and doesn't panic. It simply watches the data long enough for the truth to reveal itself. If you've been here before, you already know what moments like this feel like. If this is your first time, think of us as that one quiet elder in the family. The person who senses something is wrong long before anyone else even notices. Now let's walk through what is actually happening. On January 28th, the Chicago Mercantile Exchange, the backbone of global futures trading, made a decision. There was no announcement, no press tour, no public justification beyond a short notice buried where only professionals look. They raised margin requirements on precious metals: gold, silver, platinum, palladium. Margins, for those unfamiliar, are not fees or prices. They are deposits, the capital a trader must post to hold a contract. They exist to ensure that traders can survive volatility without collapsing the exchange itself. Raising margins does one thing exceptionally well. It makes holding positions expensive, fast. After the first increase, gold margins jumped more than 30%. Silver rose over 36%. Platinum surged, palladium followed. These were not minor adjustments. They were forceful. But what happened next is what changed the entire story. 72 hours later, the CME did it again. Not a correction, not a pause. Another hike, stacked directly on top of the first. This is almost never done, because when margins are raised twice in rapid succession, the effect is exponential. Traders don't feel pressure. They hit a wall. For silver specifically, the impact was devastating. In less than 3 days, the capital required to hold a single contract more than doubled. And for many traders, especially smaller funds, newer participants, and leveraged positions, doubling capital requirements overnight is not an inconvenience. It is an exit order. Officially, the CME explained these moves as risk management. Volatility had increased. Prices had swung violently. Protection was necessary. On paper, this explanation is reasonable, but markets are not judged by explanations. They are judged by timing. These margin hikes came after one of the largest single-day collapses in silver's history. They came after major institutions were observed closing short positions near the exact bottom of the crash. They came after price discovery had already done its damage. Raising margins before volatility limits risk. Raising margins after a collapse amplifies damage. And traders noticed. Because when margin hikes arrive at moments like this, they do not simply protect the exchange, they force behavior. They force selling. They force liquidation. They remove weaker hands from the market regardless of conviction or fundamentals. And when forced selling meets thin liquidity, prices do not fall gently. They gap. As Asian markets prepare to open, the most important question is not whether silver will rise or fall tonight. That is a distraction. The real question is this: how many traders can still afford to stay? Because markets don't break when prices move. They break when participants are removed. And right now, removal is accelerating. Now step away from futures contracts and price charts and walk into the physical market. Imagine entering a store where shelves are empty, not because customers bought everything, but because nothing new is arriving. That is the current state of physical silver. One of the industry AS most respected dealers publicly admitted they are uncertain whether they will be able to source additional silver at all. Not delayed, not expensive, uncertain. A major US mint halted silver sales entirely. A leading UK dealer followed. Multiple supply chains, across continents, paused within the same window of time. This is not coincidence, this is convergence. To understand why this matters, one distinction must be clear. Paper silver is a promise. Physical silver is a product. Paper silver can be created, traded, and settled without metal ever moving. Physical silver must be mined, refined, transported, insured, and stored. And right now, these two versions of the same asset are telling opposite stories. On screens, silver collapsed. In vaults, silver disappeared. This condition has a name, dislocation. And dislocations do not persist. They resolve violently. Now look east. In Shanghai, spot silver trades far above U.S. futures prices. Not by a few percent, by double-digit margins. Move further into retail physical markets. Platforms where real buyers pay real money, and the premium explodes. In some cases, physical silver is selling for nearly double the U.S. paper price. That difference is not irrational. It is diagnostic. It tells us where demand exists. It tells us where supply is breaking. And it tells us which market is no longer trusted. Based on global supply, industrial demand, mining costs, and inventory flows, silver's fundamental value sits near $130 per ounce. Not $85, not $160, $130. That means U.S. paper silver is trading at a historic discount. Physical Asian silver is trading at a scarcity premium. Every time this exact condition has appeared in history, it has resolved the same way. Not slowly, not politely, but decisively. Tonight is not about headlines. It is not about predictions. It is not about hype. It is about alignment. When Asia opens, real demand meets real inventory. There are no illusions, no delay mechanisms, no margin games. And when that happens, one market must adjust. Either paper prices move toward reality, or the gap widens until it becomes impossible to ignore. That decision begins tonight. To understand why this moment matters, you have to stop thinking about silver as a metal and start thinking about it as a system. Most people assume the price of silver is determined by supply and demand. That is the story they are told. But it is incomplete. It misses the mechanism that really moves this market: leverage. For decades, the silver market has been built on an assumption so fragile that it only works as long as nobody questions it, that paper claims and physical metal are interchangeable. They are not. In the paper market, silver can be created instantly. Contracts can be written, rolled, rehypothecated, and multiplied without a single ounce ever moving. One bar of silver can support dozens, sometimes hundreds, of claims. And as long as confidence holds, that system works. But confidence is fragile, and right now that confidence is cracking. Raising margin requirements from roughly $25,000 to nearly $66,000 is not a routine adjustment. It is a pressure move. It is a tool designed to remove weaker participants, reduce open interest, and slow new positions from entering the market. But more importantly, it buys time. Time for exchanges, time for clearing members, time for a system that is dangerously close to being asked a question it cannot answer. How many of these paper claims actually correspond to real metal? At the exact same moment that leverage is being restricted on paper contracts, physical silver is doing something entirely different. It is disappearing, not because of demand fluctuations, not because of pricing errors, not because buyers are hoarding irrationally. It is simply not showing up. Bars sit in vaults. Dealers close their order books. Mints stop selling. Delivery times stretch from days to weeks to unavailable. No chart can capture this. No spreadsheet can explain it. This is a real-world failure, quietly unfolding. That 90+% gap between paper silver and real-world transaction prices is not inefficiency. It is refusal. Refusal by holders to sell. Refusal by suppliers to promise delivery. Refusal of reality to conform to paper math. And this is why tonight's Asian Open matters so profoundly. Asian markets historically do something Western markets avoid. They take delivery seriously. They are less tolerant of cash settlements, less patient with excuses, less willing to accept equivalent value instead of actual metal. When Asia opens tonight, liquidity will return, but so will scrutiny. If paper selling resumes without real backing, the fracture widens. If delivery demand increases, the system tightens. And if neither side yields, something breaks. Not loudly, not instantly, but irreversibly. Confidence erodes in quiet moments like this. When rules change, margins jump, and supply vanishes without explanation, confidence leaves. And once it leaves, it does not return quickly. Every participant in this system is watching, often silently. Banks, funds, clearinghouses, refiners, and even some governments know the mechanics behind these moves. They know the stakes, they know the signals, and some are positioning themselves accordingly. Who benefits from this? Those who are prepared for physical scarcity, those who understand that paper can mislead, those who can act quickly when the gap between promise and reality reaches the breaking point. Who suffers? Retail investors largely. People outside the institutional loop are the last to know, but the first to feel the consequences. This is how wealth transfers quietly over days and weeks without a headline ever explaining it. A margin hike here, supply pause there, a widening premium in Asia. Small moves that accumulate into decisive action. Consider the mechanics. A single leveraged position on COMEX might be forced to liquidate because of margin pressure. That sale doesn't just impact the trader. It cascades, triggering stops, creating temporary oversupply in paper markets and driving prices lower for everyone who thought they were safe. Meanwhile, the real-world physical market reacts in the opposite direction. Buyers see the scarcity and they pay premiums. Mints that were previously accessible now close their order books. Dealers stop quoting. Bars that were available yesterday are no longer for sale today. The gap expands. The divergence grows. And the market is caught in two realities simultaneously. History provides context. In 2008, during the financial crisis, similar dislocations appeared in commodities markets. Paper contracts overstated availability, while physical shortages created chaos for anyone trying to secure real assets. Investors who understood the difference were able to protect themselves. Those who did not, lost. Tonight, the conditions are even more acute. Paper contracts are heavily leveraged. Margins have been doubled in less than 72 hours. Physical supply chains are strained, if not completely paused. And Asian buyers, with a reputation for taking delivery seriously, are about to enter the stage. The result is almost impossible to predict with precision, but easy to understand in principle. The paper market cannot ignore reality forever. At some point, the discrepancy must resolve. And when it does, it will do so decisively. This is why every movement in Shanghai, every retail order placed, every bar of silver that changes hands matters. These are not incremental shifts. They are signals, like ripples before an earthquake. And psychology plays a role too. Markets are composed of humans, and humans respond to pressure. Margin calls create stress. Scarcity creates urgency. Fear amplifies action. When leveraged participants panic, they sell. When buyers hesitate, they miss opportunity. When confidence falters, liquidity evaporates. Tonight, all of these forces converge. Leverage, scarcity, psychology, and timing all point toward a critical moment of alignment. Some participants will blink first, some will double down, some will exit entirely, and the market will adjust accordingly. The lesson for anyone watching carefully is clear. Do not focus on price alone. Focus on structure, focus on supply, and focus on real-world behavior. Those are the indicators that reveal truth before it hits the headlines. And remember, moments like this do not happen often. When they do, they are decisive. Small differences in observation, timing, and action can mean the difference between opportunity and exposure. So as the Asian session unfolds tonight, watch carefully. Spot prices in Shanghai versus COMEX, premiums on physical silver, delivery reports and mint availability, margin call volumes, and open interest. Each of these elements will signal what the market is truly doing before it shows up on mainstream reporting. And most importantly, understand that this is a system-wide stress test, not just for silver, but for the mechanisms that govern paper claims, physical supply, and leverage in commodity markets. Those who prepare now, who understand the divergence, who track indicators, who respect the system's fragility, will be positioned to navigate the coming adjustments. Those who ignore it will experience the consequences, silently, painfully, and often too late. If this breakdown matters to you, make sure you're subscribed to Economic Records. We don't react late. We document early, we watch quietly so you can see clearly. Like the video, subscribe to the channel, and stay with us, because the moments that matter most never come with sirens.